Have you ever looked at an option price and wondered, why is this so expensive, when the stock hasn't even moved? The answer? Implied volatility, a hidden but powerful force in the world of options trading. In this video, you'll learn what implied volatility is, how it affects option prices, and how traders use it to their advantage. Let's break it down. Implied volatility, or IFA, is the market's estimate of how much a stock might move in the future. It doesn't tell you which way the stock will move. It only measures how much movement traders expect. It's called implied because it's not directly observable. We infer it from the price of options using models like Black-Scholes or binomial models. Here's the idea. If an option is trading for more than expected, and nothing else has changed, the only explanation is the expected volatility has increased. The market is pricing in a bigger move. That's why IFA goes up when there's uncertainty, around earnings, news releases, or major events. Let's clear up one common confusion. Implied volatility is not the same as historical volatility. Historical volatility measures how much a stock has moved in the past, based on real price data. Implied volatility is about the future, what traders think will happen. Think of it like this. Historical volatility is looking in the rearview mirror. Implied volatility is looking through the windshield, and trying to guess what's coming. So, what causes implied volatility to change? Here are a few common drivers. Earnings reports, one of the biggest catalysts. Before earnings, IFA rises. After earnings, IFA usually drops fast, that's known as a volatility crush. News events, lawsuits, mergers, product launches, CEO changes. Market sentiment, fear increases volatility. During market crashes, IFA spikes. In calm markets, it tends to decline. Supply and demand, if many traders are buying options, the demand pushes up prices, and IFA along with it. The key takeaway? Implied volatility is driven by expectation and emotion, not fundamentals. Now let's connect IFA to what you really care about, option prices. When IFA increases, option premiums go up, for both calls and puts. That's because the probability of the option finishing in the money goes up with volatility. Here's a simple example. Let's say a stock is trading at $100. A $105 call option might cost $2 when IFA is low. But if IFA rises, that same call might now cost $4, even though the stock price hasn't changed. That extra cost is the volatility premium. So, as a trader, if you buy options, you want to buy when IFA is low. If you sell options, you want to sell when IFA is high, so you collect more premium. Let's talk about a common mistake: buying options before earnings, expecting a big move, only to lose money, even if you're right on direction. Here's why. Before earnings, IFA is high, sometimes 80%, 100%, or more. Everyone's expecting a big move. Option premiums are inflated. But after earnings, no matter what happens, IFA drops sharply. That's the volatility crush. So even if the stock moves a bit in your favor, the drop in IFA can wipe out your gains. Moral of the story? Be cautious when buying options with high IFA, you may be paying too much. So how do you know if IFA is high or low? Two key tools, IFA rank and IFA percentile. IFA rank compares current IFA to its range over the past year. If IFA rank is 80, that means today's IFA is higher than 80% of the readings from the past 12 months. IFA percentile tells you how often IFA has been below the current level. A 90 percentile means it's higher than 90% of the past values. These tools help you answer: are options cheap or expensive right now, compared to history? Smart traders use these metrics to time their trades. Sell options when IFA is high, buy when IFA is low. Let's match IFA to some common option strategies. When IFA is high, consider selling options, naked puts, covered calls, credit spreads, iron condors. These all benefit from a drop in volatility. When 4 is low, you might consider buying calls or puts, straddles or strangles, if you expect volatility to rise. Debit spreads. The key is aligning your strategy with the volatility environment. Let's recap what you've learned. Implied volatility shows expected future movement, not direction. It's calculated from option prices and changes with market sentiment and demand. High 4 inflates option premiums, great for sellers, risky for buyers. Use tools like 4 rank and 4 percentile to judge if 4 is relatively high or low. Tailor your trading strategy to the current 4 environment. Understanding implied volatility won't just help you price options better, it will help you become a smarter, more strategic trader. Thanks for watching. If you found this valuable, hit the like button, subscribe for more trading insights, and check out our next video on how MACD is used in technical analysis.